Imagine that Clavelu S.A., a Spanish manufacturing company, wants to buy their raw materials from the United States. These materials are sold in dollars, but the company financial capital is in euros. So, what should this company do? The foreign exchange market, also known as Forex or currency market, is a place where individuals or companies can meet to buy or sell currencies. It is the biggest market in the world. In fact, Forex trades around $5 trillion per day, around 30 days of the New York Stock trades. The Forex market has no physical location or central of exchange, as it is a global, decentralized market and trades 24 hours, 5 days a week.
Currency trading is the change of one currency for another. In the Forex market, currencies must be traded in pairs. When a trader buys a currency, they are also selling a currency at the same time, so the price of a currency is always a rate regarding to another one. The value of a currency fluctuates based on different factors, economical, political, or environmental, and traders try to take an advantage of these changes by predicting how these fluctuations will behave.
If Yin has 100 euros and he wants to change them to dollars, at today's exchange rate, he will have $140. A few weeks later, the rate changes. Jin has not spent any dollar and would like to have euros again. But now, because of the new rate, he will have 126 euros back.
Like any other market, this one works by the demand and supply law. Considering the euro-dollar exchange, if the euro demand increases, it means that this currency has increased in value, so now we can obtain more dollars per each euro.
In the same way, if we think about the dollar market, if the supply of this currency increases, the dollar will be devalued against euro, so per each dollar we can obtain a lower number of euros. If the euro currency has increased in value, the imports will rise as a reaction to having more dollars per each euro. So now, buying internationally is cheaper than domestically. However, the exports will decrease because for Americans, buying in Spain is more expensive. So they will cut down their consumption here as a reaction to a devalued dollar. On the other hand, if Clavelu invests in the United States, perhaps it would obtain losses, because when they convert dollars into euros for getting their revenues, per each dollar they will receive fewer euros, because the dollar is devalued. To conclude, when a company has operations in other countries whose currency is devalued against their own currency, the company should import rather than invest in order to obtain benefits. If the company invests in that country's currency while its currency is devalued, it will lose money.